Good afternoon and welcome to Capital Account. I'm Lauren Lister here in Washington, D.C. These are your headlines for April 24th. 2012. With Italian and Spanish bond yields back on the rise, we've recently seen the Dutch government collapse under the weight of austerity talks, and French President Nicolas Sarkozy did not win first place in the first round of French elections. Now, as price discovery is guarded against in the financial markets, are we seeing its emergence reflected in the delicacy of Eurozone governments as discontent is being priced into the democratic process? We'll answer that, or try to. Meanwhile, central banks may not be waiting to find out if major currencies, the euro or the U.S. dollar for that matter, will collapse or be devalued. They're stocking up on gold. IMF data shows Mexico added close to 17 tons of gold to its reserves in March. Turkey, Russia, and Kazakhstan are buying more too. We speak with GoldMoney founder James Turk about why he thinks central banks could be guarding themselves from the confetti cannon currency being shot around the globe. And in the U.S., we've seen oil prices become a political football in an election year. We'll look at what the onion market can teach us about oil speculation. Let's get to today's Capital Account. So is the democratic process tearing down the house of cards Eurozone policymakers have built to solve the debt crisis? Let's take stock of what's been going on politically in Europe. You can decide for yourself. Nicolas Sarkozy, the French president, Merkozy's second half, did not win the first round of French elections. He came in second place. Now he and his first place opponent are reportedly vying for the votes of the far-right National Front Party. Now they fielded first place candidate, or third place, excuse me, I should have said, Marine Le Pen. Now, what's interesting is that as Europe integrates further, internally, certain countries have seen the rise in fringe political parties, nationalist or right-wing movements. Now, France is an example. Marine Le Pen, though she was defeated, got close to 18% of the vote. Her party seeing unprecedented gains. Now, she reportedly campaigned on anti-immigration and economically on protectionism and on exiting the euro. The Dutch Freedom Party, that's another example. The Dutch government collapsed and the prime minister resigned Monday after the far-right party withdrew its support for the government and withdrew from talks about austerity. Now, this is interesting because the northern countries, the richer countries, surplus countries, have seen themselves as the good guys, doing the right thing financially, economically. So what happens if one of these countries rocks the Eurozone boat or jumps ship entirely? And what does all of this mean for precious metals? Well, we spoke to James Turk about it. He's founder of GoldMoney and the author of The Collapse of the Dollar and How to Profit from It. Make a fortune by investing in gold and other hard assets. Here's our conversation. We've seen a lot of coverage of protests in the periphery in Greece and Spain and Portugal. We haven't seen that kind of discontent in these richer countries. I'm just asking you, I know you're not a political expert, but you are in Europe. Is there any kind of sense that there could be such discontent in these richer countries that we could see one of them pull out of the Eurozone or the euro?
Yeah, it really is interesting that they are spreading, and it's really recognizing, that the underlying problem is the same in the South as it is in the North. The problem has been mislabeled. It's called a crisis of capitalism, but it's really not that. It's a crisis of socialism. And both the socialist governments in the North, or those that favor, heavy government spending, and those in the South are being affected with it. And people who rely on governments and governments who make these promises have to rethink that relationship. It comes back to one of my favorite quotes from Margaret Thatcher a few years ago. She said that the problem with socialism is that eventually governments run out of other people's money. And that's exactly what's happening in Europe. That actually happened long ago, but not only did they run out of money, but they're now running out of borrowing capacity. They tried to keep the game going by borrowing more and more money, but they've reached a stage where they can't borrow anymore. So what governments in Europe have to have to rethink, and this is true in the North as well as it is in the South, some of the socialist policies that they followed in the past, because literally they've run out of money, they've run out of borrowing capacity, and that's the core issue that's behind the crisis.
Let's talk a little bit more about what impact this could have on the euro, because it's interesting. This Dutch Freedom Party commissioned a report that we actually covered back in March that Lombard Research did called Netherlands and the Euro, and it showed why the Netherlands would benefit by leaving the euro, saying that Italy, Greece, and Spain, Portugal would need a lot more money, and Germany and the Netherlands would end up footing the bill. And the party's leader of the Dutch Freedom Party is a Eurosceptic, to say the least. What impact would it have if a country like the Netherlands exited the euro?
Yeah, I think what it's doing is it's highlighting the problems of the euro itself and the way it's been managed. You know, there's nothing wrong conceptually or in theory with a single currency. After all, the United States has a single currency. You know, the people in California use the same currency that the people in New York do, and, you know, throughout the 50 states. But what's happened in Europe is that people in Germany are being forced to bail out people in Greece and, you know, bail out governments and banks in Greece. And it's taken a single currency beyond just the neutral currency that it's supposed to be, and it's turned into a political currency. Whenever you mix politics and money, you end up having a lot of problems. One of the reasons why the Bundesbank was so successful from 1950 until 2000, managing the Deutschmark, is they very clearly guarded their independence. They didn't finance government deficits. They maintained the purchasing power and the stability of the euro. But the ECB has gone another way, and it's not too surprising to see some of the problems that we're seeing in the euro, rising inflation and some of these issues that are tearing countries apart rather than bringing them together, which is what the hope was for the euro initially.
Well, yeah, and speaking of the ECB, we see Italian and Spanish yields on the rise again. We've seen the ECB step in the past, buy bonds in the secondary market through programs like the S&P. Recently, we've heard a European central banker come out and remind everybody, hey, this is still a tool in our tool chest. Do you think that the political will continue for the foreseeable future for these kind of policies to try to put a ceiling on yields?
Yeah, you know, but they may try to do this. They may try to buy more paper in the ECB to keep yields from rising. But the ECB cannot keep all yields down forever. It's just a practical impossibility. And just taking the risk away from, you know, a commercial bank and putting it on the ECB's bank's balance sheet doesn't really solve any problems. The underlying problem, as I mentioned earlier, is governments have run out of money. They've run out of borrowing capacity. They cannot take on any more debt. Yet they continue to try to do that. Experience has always shown in monetary history that when governments try to take on too much debt and force that debt into the central bank, the currency ultimately gets destroyed. So I wouldn't be too surprised if the euro does break up and Germany will stick to German discipline and go its own way, while the rest of Europe might go back to national currencies. How it plays out, no one knows, but it's clear that the present system as it's structured, its shelf life is limited. It's not going to last much longer.
Well, then let's talk about what all of this means and what the effect is of it on precious metals. A lot of the scenarios you just mentioned, a euro collapse or a eurozone collapse, as well as the policies that central banks are continuing to try to pursue, along with the reality of these indebted countries.
Yeah, well, individuals should take a cue from some of the central banks outside of Europe and what they're doing. You know, central banks are accumulating gold, and they're accumulating gold because it's a safe haven. It's a tangible asset that doesn't have counterparty risk, meaning that it's not dependent on any government or any bank's promise. It's dependent on the fact that the market gives it value because gold has been money for 5,000 years and is likely to remain money for the foreseeable future. So one of the points that I've been making for years is that every individual has to act like their own central bank. And what that means is that you have to have your own gold or silver reserves, you know, own physical metal. When you own that physical metal, you know you're protected from all of the monetary chaos that we've already seen and the monetary chaos that's yet to come. Your wealth, your purchasing power will be preserved by owning these physical metals. And the key is don't look at the price of the metals, look at whether they're undervalued, and they still are undervalued. So despite the volatility and price fluctuations you might see, the fact is that they're still undervalued is the important point that you should be focusing on and why you should continue accumulating precious metals.
That's interesting. And since you mentioned the central banks, I thought it was very fascinating that IMF data just out shows that Mexico added close to 17 tons of gold to its reserves in March. Turkey, Russia, Kazakhstan all increased their holdings of gold. This is a continuation of a trend you spoke to, which is central banks stocking up on gold. What do you think they're bracing for? And since you mentioned the euro, are they bracing for a euro collapse?
Well, what would you rather own, a euro or a dollar, or would you rather own gold? I think the central banks are voting for gold, and it's probably the logical response.
Well, and along the lines of the central banks, Mr. Turk, one thing that we've talked about in the past is allegations of manipulation of the gold market. And one argument that people make is that central banks are involved in manipulation of the gold market. So how do you reconcile the fact that they're stocking up on gold while at the same time there are arguments that they're manipulating it? I mean, are they manipulating it to push the price down to buy on the dips?
Well, there are hundreds of central banks around the world, and there's some that are accumulating, and there's some that in the past had been distorting in order to keep the price of gold low. The reason why central banks like the U.S. Treasury or perhaps some of the European central banks have an incentive is they want to keep national currencies looking good, even though they're being badly managed and have policies that are destroying the purchasing power of those currencies. Gold is a messenger. When the gold price rises, people start to understand that something's happening with their local currency, and as a consequence, they move to gold. The incentive of the Treasury is to keep people in the U.S. dollars, because if you keep people believing that the dollar has value, that gives power to the U.S. Treasury and maintains the present system as it's been structured since the end of the Second World War.
So do you think that there will be a day ultimately when the price of gold will explode upwards because there won't be anyone left to buy on the margin?
Yeah, there will, but maybe the better way of describing it is not that the price of gold is going to explode upward, but the purchasing power of the dollar collapses, which is the title of my book going back to 2004, The Collapse of the Dollar. Everything that I wrote and my co-author John Rubino wrote about back then is still very much true today. It's just taking much longer for it all to happen, simply because governments and central banks have been kicking the can down the road, as the saying goes. But I like to say that that can is no longer a can, it's a 2-ton boulder, and it's not going to be kicked much further.
Interesting. And I know you don't have a crystal ball. You can't predict when this will happen or what the chain of events will be, but you are still a believer that there will be a collapse of the dollar and that will be nearer rather than later term. And I guess I want to know what kind of a scenario it would be that we'd see that.
Well, it's really hard to predict. I mean, you can go to a place like Zimbabwe and see what a collapse of that currency did to that economy. But when you're talking about the world...
And we will have more with James Turk after the break. And also still ahead, last week we saw President Obama pledge to ramp up speculation of oil futures. We'll give you our 3 cents on what the onion market has to say about that. But first, your closing market numbers.
We just put a picture of me when I was like 9 years old on To Tell the Truth.
I have a confession. I am a total ghetto princess. I love rap and hip-hop music and Christian music.
I thought he was kind of a dick yesterday.
I'm very proud of the role that Al Jazeera has played.
You know how sometimes you see a story and it seems so whole and complete, you think you understand it, and then you glimpse something else. You hear or see some other part of it and realize everything you thought you knew, you don't know? I'm Tom Hartman. Welcome to The Big Picture.
What drives the world?
The fear-mongering used by politicians.
Who makes decisions?
Considerable breakthrough has already been made.
Who can you trust?
No one who is imbued
with a global missionary zeal.
Where are we heading?
State-controlled capitalism is called fascism.
When nobody dares to ask, we do. RT, question more.
All right, welcome back. Before the break, our guest was explaining why he believes that the collapse of the U.S. dollar is still coming, despite the fact that central banks have kicked the can down the road, which he now calls a boulder. He explained further why. Let's listen to what James Turk, founder of GoldMoney and author of The Collapse of the Dollar and How to Profit from It, said about that.
Collapse of that currency did to that economy. But when you're talking about the world's reserve currency collapsing, we've never been here before, so there's no precedent to say this is going to happen or that's going to happen. But if you stop and think that the euro is mainly backed by the U.S. dollar, if the U.S. dollar goes into the black hole, will the gravitational pull the euro and the other fiat currencies that are using dollars as reserves, like the Japanese yen, will they go into the black hole along with the U.S. dollar? I think that's what the possibility is. And central banks are obviously worried about that, and that's why they're taking these steps that they're taking. You know, the long-term refinancing operation from the ECB, the huge swap lines that the Federal Reserve is extending to Europe. Mm-hmm. But these things are not solving the underlying problem. There's too much debt. That debt has to be repaid or written off by the banks, and the central banks are afraid if all of the bad debts are written off, most of the banking system worldwide would be insolvent. But it's an inevitability that these debts have to disappear one way or the other, and unfortunately central banks today are not addressing the heart of the problem.
Are you saying they're protecting the banks at the expense possible of the currencies and faith in the currencies?
Yeah, they're protecting their banks, and they're protecting the way the system presently works. You know, there's a relationship between the governments and the banks. All of this new financing that the Spanish government did, or a large portion of it, was bought by the Spanish banks. That gave the Spanish government the currency it needed to continue fulfilling its promises. But the point I was making at the very beginning of this interview, we're pretty close to the end of the line here. Mm-hmm. And my time frame has always been 2013 to 2015 when things are going to blow up. And we are, I think, moving toward that kind of time frame that eventually central banks are going to have to realize that the policies that they're pursuing are no longer sustainable. Governments are going to have to recognize that they cannot count on commercial banks to buy government paper to give them the currency that they want to spend, and that we're going to need Bundesbank-style discipline on the euro, and not just the euro, but all of the world's fiat currencies. In the absence of that Bundesbank fiscal discipline that made the Bundesbank, the Deutschmark, a great currency for 50 years, it's inevitable that fiat currencies are going to collapse, go over the end of the cliff, or however you want to describe it.
Right. Policymakers still appear to be trying. If you watch the IMF, they're just thinking, oh, hey, if we keep trying to paper it over with a large enough bailout fund, maybe this will go away, but it certainly isn't. Meanwhile, I want to talk about the issue of counterparty risk, because here in Washington today, Mr. Turk, there's a hearing going on about how to prevent an MF Global type collapse from happening again, a firm that collapses, taking customer money with it. Now, gold is something that a lot of people own through ETFs, futures, and other derivatives, which have counterparty risk. Do you think people should be liquidating these positions and going into physical gold?
Yeah, I really do. But let's look at it from a big picture point of view. When you're talking about wealth, wealth comes in two different forms. It comes in tangible assets, be it gold, silver, houses, farmland, timberland, and it comes in financial assets, you know, bank accounts, insurance accounts, and that type of thing. Financial assets have counterparty risk associated with them. The value of that asset is dependent on someone's promise, whereas a tangible asset, the value is in the asset itself. And when you're in a financial bust, people are concerned about the promises that have been broken and are likely to be broken as the financial bust continues. So it's very natural to see people moving out of financial assets into tangible assets, and you're starting to see that. You're even seeing people move out of questionable financial assets into what they think are safer financial assets. So there's been a huge flow of euros from Southern Europe into Northern Europe, thinking that the Northern European banks are better than the Southern European banks. But eventually, when this financial crisis comes to its final conclusion, there'll be, I think, a tidal wave of people moving out of financial assets into tangible assets of all sorts, because you're better off owning a commercial building in London or Paris or Berlin than you are having a huge amount of money sitting in a bank, regardless where that bank happens to be in the world today, because there's so many bad assets in the banking system.
Yeah, that's a really interesting analysis. One slightly more specific issue, because I wouldn't want to miss the opportunity to get a little more specifically into gold with you. Miners have underperformed the market for physical gold recently. One reason that I've seen given is that tax policies in the countries within which they are domiciled have affected them. Why do you think the reason is that miners have underperformed the physical market?
Yeah, it's not just recently. If you really look at it, gold's been in a bull market for 12 years, and miners have been in a bear market, really. The way I measure the price of mining stocks in terms of gold, not in terms of dollars or euros, they've been in a bear market for 15 years, going back to the collapse of Bre-X. Share prices are a function of two things. They're a function of price and they're a function of earnings. And both of those things are absolute numbers that we can look at, but sentiment really determines the ratio, the price-earning ratio. And for the past 15 years, the sentiment toward the mining shares has just continually been negative. It started with the collapse of Bre-X. It continued with some of the disastrous hedging programs in the banking system. People then saw the ETFs as an easier way to have exposure to the gold sector than taking the risk of owning a mining stock. And basically, that's continued to this day. But we're at a historic moment in time that the mining shares have never been this undervalued. And I'm basically a value investor, so I look at the situation and say to myself, well, I should just continue accumulating value because that's where basically the value is. But the interesting thing is not only are the mining shares undervalued, but gold is undervalued too, as is silver. So I think the whole sector is a place where people should be putting more and more of their assets, view gold to be a form of savings. And when you're accumulating gold, you're saving sound money, and I think that's a good thing.
Perfect note to end on our And we will leave it at that. That was James Turk, author and founder of GoldMoney. All right, we couldn't leave you without wrapping up with some loose change. Dimitri and Shannon, we have something really funny to tell you. So before joining the Federal Reserve, Chairman Ben Bernanke was Professor Ben Bernanke, as many people know or have been reminded with his recent PR blitz of college classes. But if you haven't seen our show, let's get a brief reminder from his stint lecturing at GW University, George Washington University, earlier this year.
Unfortunately, the Fed met its first great challenge in the Great Depression, and it failed, both on the monetary policy side and on the financial stability side.
Now, we played that because the Great Depression was his expertise as an academic, and Paul Krugman, in today's New York Times Magazine, writes about the Bernanke conundrum, the divergence between what Professor Bernanke advocated and what Chairman Bernanke has actually done. And Krugman argues that he has gone too far from his academic roots and needs to do much more. He argues that Chairman Bernanke's Fed has been much more passive than Professor Bernanke's writings would have led us to believe. So he says Bernanke has not done enough, and that really he's not been enough of the academic that he once was.
Yeah, because obviously I think that Ben Bernanke is a little cuckoo.
Well, and you don't even believe Ben Bernanke should exist, because I think you would probably argue against a Fed
existing. He shouldn't exist, right. Certainly not should the chairman position. Maybe Bernanke himself should not exist also.
Oh,
but this just goes to show you, this kind of helps you peer into the mind of Paul Krugman. And you can just see how radical he is, because Ben Bernanke is a crazy academic. I mean, he's extremely academic. Everything he's doing is applying his crazy theories to the real world, and he's not seeing the results he wants, so he's saying, I'm going to apply more of my theories. Okay? Right. So this just shows you how much of an academic Paul Krugman is, because he's saying, you're not living in Fantasyland enough, Ben.
Right.
You need to come live with Fantasyland with me. Who cares about the real world? Just do more of whatever you want and live in Fantasyland. Look at your models. Don't look at reality.
Well, because he's saying, the thing is, interest rates are at zero. They can't go lower. So you can't lower interest rates. But you should do more. You should find something else to do instead of looking at the fact that, okay, if zero interest rates aren't helping unemployment the way that you would like it to, doesn't that say something?
Well, that's the thing. He's saying, so that's why you hear people like Paul Krugman and others talk about negative rates, because they want, they're constrained by the laws of gravity.
By the laws of reality.
Right, so they want to enter this fantasy world, and that's why they want to bend time and space, right? That's why we use that metaphor about destroying the space-time continuum.
Right.
That's what Paul Krugman and Ben Bernanke want to do. They want to take rates negative. They want to distort all of reality and space and time.
And this even shows that, because Krugman wants to go back to the future to go get Professor Bernanke and bring him back now so that he can distort the space-time continuum further. Shannon, you want to add anything?
Those who can do, those who can't teach, and those who aren't in the position write into the New York Times Magazine about it.
The people
or have a column in the New York Times.
The people sitting with the coffee. Yeah, I mean, I like the Back to the Future thing. I like that.
I like the adage to end on. Let's move on, because last week, President Obama went after oil speculators. We covered it. Of course, he's dealing with the high price of oil in an election year, and so in response, he pledged to go after evil speculators with more regulation. Take a listen.
We can't afford a situation where speculators artificially manipulate markets by buying up oil, creating the perception of a shortage, and driving prices higher.
But do oil speculators really drive the prices higher? It's something that's heavily debated. We've debated it. Take a look at this comparison, though, made by an AEI scholar and Professor Mark J. Perry, brought to us by Reason in a great piece, looking at the volatility in the onion market versus crude oil. Onions are the blue, extremely volatile market, and crude is the red, much less volatile. Now, the big takeaway here, guess what you can't speculate in? Onions. Onions futures are not allowed, because onion farmers back in the 1950s thought that traders, that speculation was increasing volatility and was leading to the extremely low prices, the falling prices of onions. So they lobbied so that there would be a ban of futures trading. And look how volatile onions are and how comparatively less volatile crude oil is. Is there something to this? Is this a good perspective for us to be looking at in this debate?
Well, yeah, because, I mean, the whole, when people blame the speculators, I mean, Obama's ridiculous. You want to talk about volatility in oil prices, stop bombing countries in the Middle East. But anyway, the reality is that you can speculate either way. So it's not that when people say it's oil speculators that are responsible for the high price in oil. No, that's just absurd, because
they can drive prices up or down.
And down. Yeah. So it just compounds the trend. If you have some sort of an oil short, and besides, having speculation, okay, is important, because a speculator is important to be there in order to help push. If prices are going to rise, it's going to give a signal to oil producers to get more supply into the market. All right, but in any case, there is speculation, but people like Obama, they use that as an excuse, as a political football.
Yeah.
It has nothing to do with
yeah, I mean, this adds to the argument that people make that speculation actually decreases volatility. Also, I just want to point out, since 2006, oil prices have risen 100%, corn is up 300%, but onions, they're up 400%. We'll leave you with that note, because that's all we have time for. Thanks so much for tuning into our show. Do not forget to follow me on Twitter at Lauren Lister, and give us feedback on the show at youtube.com/Capital Account. You won't want to miss tomorrow. We will have our favorite Zero Hedge blogger, English Bob, on the show for his inaugural Capital Account debut to talk about the Fed. The interest rate decision is coming out tomorrow, and Bernanke is giving a press conference. We'll give you our 3 cents on it, I'm sure. But for now, from everyone here at Capital Account, thanks for watching and have a great night.